Welcome to Talk Tickers, your professional guide to what really matters in financial markets. Today, we are doing a deep dive into a financial strategy that really lives on a knife's edge between market efficiency and systemic risk.
It really does.
We're talking about the Treasury Cash Futures basis trade. It's this highly leveraged arbitrage mainly run by hedge funds.
And the narrative is completely split, isn't it?
Absolutely. Critics say it's a ticking time bomb, a hitting risk. But proponents will argue it's essential, that it's the oil that keeps the massive $25 trillion US Treasury market running.
That's a perfect way to put it. This isn't some obscure academic topic. It's the structural glue that connects three enormous critical markets.
Okay, so you have the cash Treasury market.
Right, the futures market,
Yeah.
and then the all-important repo market. Understanding how this trade works, its fragility, its benefits, that's really key to assessing the stability of the whole global financial system.
So let's start there. Let's get a snapshot of the current debate. The trade itself is, well, it's selling Treasury futures and buying the actual Treasury security.
At the same time.
And it's gotten a ton of attention lately because, the Treasury market itself has just ballooned in size.
It really has. And you have major bodies, the Bank for International Settlements, even the Fed, putting out reports. They're pointing to the absolute volume of short futures positions.
Which is the hedge fund side of this trade.
Exactly. And they're saying those volumes are now comparable to what we saw right before the big market dislocations.
You mean September 2019 with the repo turmoil, and then, of course, March 2020.
The very same.
Yeah.
And they're explicitly warning that a disorderly unwind could be a major financial vulnerability.
Okay, so those absolute numbers, they sound pretty scary. They made for a great headline. But context is everything here, isn't it?
It's the only thing that matters. You have to look at these numbers relative to the size of the market they're in.
And that market has grown massively.
Massively. The U.S. government debt outstanding grew by 50% from just before COVID to September 2023. We're talking a 50% bigger pond.
So it makes sense there'd be more fish in it.
Precisely. So when you look at the short futures positions, not in absolute dollars, but as a percentage of the total debt out there, the story completely changes.
So what do those numbers look like?
Well, back in July 2019, at that stress peak, shorts were about 5.8% of marketable debt.
Okay.
But in September 2023, that number was only 4.1%.
So it's actually below the historical stress peaks.
Well below. And that suggests that the market's capacity to handle this stuff has grown along with the debt load. The market is just deeper now.
So the whole debate really boils down to this one question. Is this trade a source of essential liquidity, or is it a hidden time bomb of hedge fund leverage sitting at the heart of the world's safest market?
That's the billion-dollar or maybe trillion-dollar question.
All right, let's unpack the mechanics. To really understand the risk, you have to get how the strategy actually works. It's a market-neutral arbitrage.
Right, which means they are not betting on interest rates going up or down.
No directionality.
None. They're just trying to capture this tiny, tiny price difference, the basis, between the cash bond and the futures contract.
It's got two parts, two legs.
Yep. The long leg, which is just buying a cash Treasury security, and it's usually a very specific one, the cheapest to deliver, or CTD.
We should pause on that for a second. The CTD, why that specific bond?
It's all about optimizing the profit. A futures contract lets the seller deliver one of several different bonds at expiration.
Ah, okay.
So the hedge fund, who is short the future, calculates which of those eligible bonds is the most profitable for them to buy today and deliver later. That's the CTD.
Got it. So that's the long leg. And the short leg
is just selling the corresponding Treasury futures contract on an exchange like the CME.
And the whole thing is profitable if the tiny price difference is bigger than their costs. But that profit only works because of leverage. And this is where it gets really interesting.
This is where the risk comes in. The leverage is massive, and it comes from two different places, one for each leg.
Let's start with the long leg, buying the cash bond.
Okay, so hedge funds don't use their own money for that. They borrow it in the Treasury repo market, often overnight, using the very Treasury they just bought as collateral.
And the cost of that borrowing is the repo rate.
Correct. And that rate has to be lower than the tiny profit they're aiming for. If the repo rate suddenly spikes, that's the rollover risk, your financing cost eats your profit, and you're forced to unwind.
So that's risk number one, financing. What's the other side?
The futures leg. When you sell that futures contract, you have to post a small amount of cash as initial margin. Think of it like a security deposit.
but that can change.
Oh, it definitely can. If the market gets volatile, the clearinghouse can demand more initial margin, or more painfully, daily variation margin to cover your losses.
The dreaded margin call.
That's it. And if volatility spikes, your cash requirement can double overnight. If you can't post that cash, you have to liquidate the position.
And that forced liquidation is the systemic event. Everyone trying to sell their cash treasuries and buy back their futures at the same exact time.
That's what creates the selling pressure that can freeze the market, just like we saw hints of in 2020.
Now, you see these crazy leverage numbers thrown around, like 70 to 1.
Yeah, and while that's theoretically possible, it's a bit misleading. The clearinghouses have actually been pretty prudent, increasing those initial margin requirements over the last year or so.
So real-world leverage is coming down.
It is. It's actually getting closer to 5-year lows, which is a good sign for stability.
Let's zoom out for a moment. Why does this trade even exist? Why are hedge funds doing this in the first place?
Because they're serving a huge need for big institutional investors.
Like pension funds.
Exactly. Pension funds, mutual funds. They want exposure to treasuries, but they'd much rather get it through futures.
Why is that?
It's about capital efficiency. To buy a bond, you need 100% of the cash up front. To get the same exposure with a future, you only need to post, say, 3% as margin.
So the pension fund frees up the other 97% of its cash to invest somewhere else.
In higher yielding assets like corporate bonds or stocks. It boosts their returns, which is good for retirees. The hedge funds are just the intermediaries, the other side of that trade, providing that capital efficiency.
Okay, let's pivot to the benefits for the rest of us. For the broader economy, this isn't just about hedge funds and pensions making money.
Not at all. There are real-world consequences. All that buying of cash treasuries from the hedge funds, it creates constant demand.
Which pushes the price of bonds up.
And pushes the yield down. And that yield is the interest rate the U.S. government pays to borrow money.
So it lowers the government's borrowing costs.
It does. There's research that suggests for every $41 billion increase in this kind of exposure, you see a measurable drop in treasury yields. That saves taxpayers real money.
But then there's the dark side. The March 2020 dash for cash is always held up as the prime example of how this can all go wrong.
It is, and it was a perfect storm. You had extreme volatility, so margin requirements on futures more than doubled in just a few days.
And at the same time, repo rates were spiking?
Exactly. So the basis traders were getting hit from both sides. Their financing costs exploded and their margin calls exploded. They had no choice but to unwind and unwind fast.
And that's where they got the blame for causing the turmoil. But the data that's come out since then sort of complicates that story.
It complicates it a lot. When you look at who was actually selling treasuries during that panic, the numbers are staggering. Foreign investors sold over $400 billion worth.
Wow.
Mutual funds sold $236 billion. And the hedge funds, the supposed villains.
How much did they sell?
They reduced their cash treasury positions by about $35 billion.
That's a tiny fraction. So why did they get all the blame?
Because of the way they sold. It wasn't the biggest volume, but it was highly concentrated, it was leveraged, and most importantly, it was forced.
Because of the margin calls.
Right. It was a rapid, simultaneous deleveraging that caused these outsized price dislocations in those very specific CTD securities. They didn't start the fire, but their forced selling was like pouring gasoline on it.
But there's even a study that found that those specific CTD bonds actually traded at higher prices than similar bonds during the chaos.
Which suggests the trade, even under stress, was providing some net liquidity at the margin. It's a really complex picture.
Okay, so the fragility was exposed, and now regulators are stepping in. The SEC has a big new rule coming.
That's right. They've mandated central clearing for most cash, treasury, and repo trades, with deadlines coming up in late 2026 and mid-2027.
And this is a huge deal for the basis trade because it's going to force the repo leg, the financing leg, into that central clearing model.
Which means imposing initial margin requirements on borrowing that cash. For a hedge fund that was getting zero haircut repo before, that's a massive increase in their collateral cost. It could change the entire economic calculus of the trade.
This brings up the single most important factor for the future of this trade, which is cross-margining.
Yes. This is everything. The clearinghouses like FICC for the cash leg and CME for the futures leg are talking about expanding their cross-margining programs.
So explain what that means in practice.
It means the two separate clearinghouses would talk to each other and recognize that these two positions, the long cash bond and the short future, are a hedge. They offset each other. Your actual market risk is close to zero.
So without cross-margining, a hedge fund has to post margin on both sides of a trade that's supposed to be risk-free.
Exactly. They post collateral for the cash leg and collateral for the futures leg separately. It makes the trade incredibly expensive, maybe even impossible to do profitably.
But with cross-margining,
If they get it right, the clearinghouses can acknowledge the true hedge nature of the risk. And the estimates are that the total collateral required for the trade could actually fall by as much as 75% from where it is today.
75%, that's a huge swing. So the regulators are at a crossroads. They want safety. But if they don't implement this intelligently, they could kill the very efficiency that helps the market function.
It's a delicate balancing act.
So at the end of the day, what does this all mean for you? The basis trade seems to be this necessary evil, a leveraged engine that needs constant watching, not a blanket ban.
I think that's right. The benefits are real lower borrowing costs, better returns for pension funds, but so is that risk of a high-speed, leveraged unwind.
Which brings us to the one question you should be asking as this all plays out over the next couple of years.
It's a big one.
If central clearing fails to fully implement efficient cross-margining for these hedge basis trades, where does the asset manager community, the pensions, the mutual funds, find a way to efficiently express their long Treasury exposure?
Because there's no easy answer to that. If the arbitrage becomes too expensive, the hedge funds will just leave.
And that forces the big asset managers out of the futures market and into the cash market.
And that drop in efficiency, that drop in liquidity, will almost certainly mean higher financing costs for the U.S. government, a cost that ultimately gets passed on to the taxpayer.
So today we unpacked the cash futures basis trade, looking at its leverage structure, the risks from financing and margin, and its really complicated role in the 2020 market turmoil.
The future of this trade really does hinge on the nitty-gritty details of this SEC clearing mandate. We encourage you to keep an eye on the relationship between Treasury issuance and leveraged fund activity. That balance is what keeps this critical engine running. Thank you for joining us for this deep dive.